Good evening, friends. Thanks for joining this call to discuss a very interesting product, HDFC Floating Rate Debt Fund. I am Ashok Kannawala, part of the products team, and with me is my colleague Ram Kumar, who will be moderator for this call. And we have Shobit Mehrotra, who is the fund manager for this fund and head of credit at HDFC Mutual Fund. Shobit, to his credit, has over 25 years of investment experience on the debt side and has seen many cycles where interest rates have moved up and down. Further to his credit, India as a country has witnessed certain credit events in last couple of years, and we are very happy to say that most of these credit events we have not been part of it, or we have not been affected or impacted by those credit events. And that's to the credit of Shobit for managing credit fund at our end. We are into 18 months of this pandemic, March 20, that's when it started all. And this past 18 months also has been equally eventful for the debt side. Of course, to begin with, there was a response to support economy, and there were liquidity bazooka and yields moved down. But as fiscal deficit widened, the consensus amongst all those people is that interest rates carry an upward bias. So that means over a certain period of time, interest rates may move up. And therefore, if you look at past 1 year return of debt, they look very healthy. But if you look forward, then there is an element of interest rate risk, because if interest rate moves up, what next? And to counter those kind of situation, or to manage those kind of situation, we believe that there is an interesting proposition in the caption fund, HDFC Floating Rate Debt Fund, which is already there with us for nearly 8 years and has an impeccable track record. And today also it's a very large fund, more than 22,000 crores. And Shobit will narrate to us why he feels this fund has a potential to generate decent returns for the investors over short to medium term. So with this, I will invite Shobit to take us through this presentation, and thereafter we'll open for question and answers. Over to you, Shobit.
Thank you, Ashok, and thank you everyone for joining in on this call today. I will cover the presentation on floating rate debt fund in 3 parts. So we'll start with a broad overview on the debt market. Then we will talk a little bit about floaters, or what floating rate instruments are, for the benefit of some of us who may not know how these instruments work. And thirdly, we will cover the strategy of how we manage this fund. So as Ashok mentioned, I think the title for this presentation, that float with the rising tide, kind of indicates that yes, we are expecting rates to rise, and this kind of a product allows you to move in line with those rising rates, or i.e. float with the rising rate. So that's how the word also floating rate has come about. Now, if we look at how things are placed today, we have seen unprecedented amount of liquidity being pumped into the markets by major central banks. So from a contraction of over 3% last year, we are looking at a very solid growth of 6% in the global GDP. Now, because of this huge amount of liquidity, because of the rising household savings rate, the growth in the current year is going to be one of the best which we haven't seen in a very, very long time, right? Over 6% global growth is really a very strong growth. Even thereafter, the expectation is that growth would remain at least over 4% or somewhere around 4.5%. So even for next 2 years, global growth environment is positive. Growth is likely to be quite strong. For India, thankfully, the second wave has been of a short duration. We have recovered fairly quickly from the second wave, and therefore the bounce back in the economy has happened fairly good in terms of the first quarter GDP growth number which we saw. But still, I think it is too early to take a full year view or call on how the growth will play out or pan out. Some of the activity indicators are indicating that maybe we have already crossed pre-pandemic levels. But I think central bank would want to wait and watch and see whether this growth can be sustained over the coming quarters, whether this is going to be durable growth or not. Then RBI would be in a position to start what we call normalization process, because as you all know, during the period of pandemic, RBI has taken several measures, several supportive measures which have been introduced into the economy because the huge amount of liquidity, the rate cuts. So all these measures which need to be normalized, I think RBI is going to wait and watch for the recovery. Now, the unprecedented nature of this pandemic really is going to have a big impact on how growth plays out. There are various kinds of forecasts for GDP growth number for the current year. RBI's number is around 9.5, and some of the analysts are already now slowly bringing it even lower than 9.5 for the current year. The worry is that the third wave is about to start, or the risk of third wave persists. So the recovery process could be quite uneven. There would be some segments of the economy which will bounce back and recover faster, and there will be other segments of the economy which will lag. So in this environment, I think RBI would not want to take a chance of acting too soon or too fast. RBI would want to see that the recovery becomes well entrenched, and only then RBI would be in a position to start the normalization process. Now, on the other hand, if we see how inflation is behaving, we can see that, globally you would have seen commodity prices are rising. We've seen how metal prices have gone through the roof. If you see in this slide, the middle chart is showing prices of aluminum, zinc, steel, all have been almost at multi-year highs. So with rising commodity prices, rising crude oil prices, and a lot of supply chain disruption, inflation, both globally as well as in India, has been rising. Now, there are two sets of views in the market on inflation. There is one camp which believes that this inflation is transitory, and as the supply disruption goes away, inflation will come down. And there is other school of thought which says that this inflation may not be transitory and may get entrenched and become more persistent. So with this kind of an environment, inflation risk is definitely a big risk which central banks are closely monitoring. But in the current environment, the focus will definitely remain on reviving growth, and inflation would perhaps take a backseat in the scheme of things for the central bank. So we feel that RBI will continue to remain more focused towards growth, And as the RBI governor has mentioned several times that this inflation is transitory, and they would want to see, inflation come down, which will perhaps happen in the third quarter of this fiscal year. And they first would want to therefore focus on growth and worry about inflation later. But at some stage, the RBI has to act. So we feel that yes, RBI action will happen, but it will happen at a very gradual pace. And we feel that yes, we are at the bottom of the rate cycle, but the normalization process from RBI would take some more time. It will be gradual. It is not going to be in a hurry. And we've seen, if you see in this slide, the shorter end yields have moved far more down. If you see that in this left side chart, it clearly shows where the 3 month, 6 month, 1 year, 2 year, all these yields have come down far more than the longer end, which gives us some indication that today the yield curve, which has become so steep, can get corrected as the normalization process begins. So we feel that this kind of a sharp move on the shorter end yields, which is driven primarily because of the huge surplus liquidity in the system, that will slowly get corrected by the yield curve reducing the steepness and becoming more flatter as we go out into the future. Now, this brings us to floating rate instruments, because floating rate instruments are the kind of instruments which are linked to short-term benchmarks, and these are the ones which will stand to benefit or gain once shorter end yields start rising and the short-term benchmarks keep going higher. So let's just quickly go through what are floating rate instruments. Broadly, there are two types of floaters, as we call them. One is your natural floater, which is basically any instrument where the coupon rate is linked to an underlying benchmark. Now, the underlying benchmark could be either a repo rate, it could be a 3-month T-bill, 6-month T-bill, 12-month T-bill rate. It could be a SBI's prime lending rate. It could be overnight rate, MIBOR. So any benchmark which is agreed with the issuer and the investor, that becomes the benchmark. Plus, it offers you a fixed spread over the tenor of the instrument. So say if a 3-month T-bill today is at 330 and the agreed spread with the issuer of the bond is say 200 basis points, then today when we start investment in this paper, the first coupon setting for the first period of say that first quarter, first 3 months would be 330 plus 2%, 5.3 will be the coupon rate. Now, this bond can have a tenor of 2 years, and every 3 months, the rate can be reset to the prevailing 3-month T-bill rate. So now, if the 3-month T-bill rate moves up from 330 to 360 or 3.60, then for the next quarter, my coupon rate on this paper becomes 360 plus 200, 560 instead of 530. So as the rates on the underlying benchmark keep changing as time progresses every quarter, the coupon of the floating rate bond also gets a new coupon, or a coupon increases to whatever is the underlying benchmark plus the spread. So it's a very simple instrument, and it is underlying benchmark. If as it moves higher, the coupon of the bond also keeps changing and keeps going higher. Now, the other way, or the second kind of floating rate instrument is what we call a synthetic floater. Now, in a synthetic floater, what happens is basically if you have investment in a fixed rate bond, supposing we have an investment in a 1-year fixed rate bond at a 5% rate. If I have bond, a AAA bond at 5%, I have bought, which is there on my portfolio. Now I want to convert this paper or this bond into a floating rate bond. So what do? I will approach different counterparties in the market. These counterparties could be banks or they can be primary dealers. Now, they will offer me what is called a swap rate for whatever period we would want to do the swap deal. I have a 1-year paper and I may decide to do a swap trade for 3 months, 6 months, or even 12 months. So I would ask for all these rates. What is the prevailing rate, swap rate on the 3 months, 6 months, 12 months? So if supposing the counterparty with whom I want to do this swap trade quotes me a level of 390, that means I have to pay 3.9 to the counterparty, and against that 3.9, I will receive the overnight MIBOR rate. Now, I am on the bond, I am earning 5%. On the swap, I'm paying 390. So the difference is 110. So my paper, in effect, becomes MIBOR plus 110 basis points. Now, MIBOR today could be around 340. And so basically what I have done is converted a fixed rate bond, which was giving me 5%, into a floating rate bond, which is linked to a MIBOR and will give me MIBOR plus 110 basis points. MIBOR today is at 340. It could go up in the future. So this is a overnight or every day it changes. As time goes by, over next 3-6 months, MIBOR rate can go from say 340 today to 4%. And if it goes to 4%, my paper, the coupon which I will earn for that particular day could be 4 plus 110, which becomes 5.1. So that is how the synthetic swap works, that basically, or synthetic floater works, that whatever fixed rate security you have on your portfolio, you swap it with floating rate, in the market with the counterparty. There is no principal risk which we are taking. It is a notional amount which we do. Supposing I have 100 crore exposure in a bond of 1 year, I could decide to do 100 crore notional value of this in a swap trade with a counterparty by paying 3.9 and receiving the MIBOR. Now, how these swap yield curve moves is a function of what the market expects future interest rates or yields to be. If today the overnight rate is say 330 or 335 and the 1-year rate is 3.9, then market is basically looking at almost 50 basis points of rise in yields happening over the course of next 1 year. So that is how the expectations play out in the swap market on the swap yield curve. We have to look at all points on the swap yield curve and look at the bond swap spreads, and then decide that whether to pay for 3 months or whether to pay for 6 months or whether to pay for 2 years. So what tenor to pay and convert my fixed to floating, whether to do it today or do it later or do it after 3 months. So all those decisions are taken by the fund manager to, in the interest of the fund, to try and optimize the portfolio's return. Now, how does the movement of interest rates impacts the pricing or the return of the floating rate bonds. Now, we all know that the mark to market impact typically on a 1 year paper, if the typically modified duration is 1, if interest rates go up by 25 basis points, there is a 25 basis points hit which 1 year duration paper has to take. And similarly, if the 5 year fixed rate bond, typically if the modified duration would be say closer to 4, if yields rise by 25 basis points, there could be almost a 1% hit on the return or the expected 1 year return on this paper. But for a floating rate bond, if yields rise, as you can see in this table, which we have shown the comparison between, say, a 3-year, 5-year versus a 3-year floater, fixed versus floating rate returns, even when yields are rising by 100 basis points, the return on the floater, when you compare that, 3-year fixed bond versus a 3-year floating rate bond, 3-year fixed is giving us a 3.5 or close to 3.47, 3.5 return, while a floating rate bond is yielding you over 5%. So in a rising rate environment, clearly the floating rate bonds always tend to outperform in terms of the expected return, and typical fixed rate bonds take the mark to market impact, while for the floating rate bonds, as yields keep rising, as the coupons keep rising, the overall return is far better than what it is on a fixed rate bond. So moving on to what this product does, HDFC floating rate debt fund. I think in today's environment, we all expect rates to slowly keep rising into the future. I think this fund is well placed. There is basically 3 kinds of investment which we do in this product. As we talked about natural floaters which we have, then we would have some fixed rate papers which have been swapped into floating, which we call the synthetic floaters. And the third very important component is our investment in short maturity instruments. And we'll just discuss how these play out. So basically in this fund, the strategy is multi-pronged. There are 4 pillars of our strategy for the floating rate fund. The first one is basically to invest in natural floaters and diversify across different benchmarks. Now, we have various benchmarks out there in the market, and the idea is to optimize and try and see which benchmark would closely represent market yields in the future, and capture that movement for our portfolio. So we have securities which are linked to 3-month T-bill. We have securities which are linked to 6-month T-bill. We have some securities which are linked to MIBOR. We have some securities which are linked to repo rate, as well as there would be some. Yeah, the 3-month, 6-month T-bills are one component. Then the repo rate and MIBOR. Those are the kind of benchmarks which we have. And hopefully in the future, as these benchmarks reflect market yields, that will get translated into rising coupons or changing coupons on our underlying holdings. So that is the first leg of the strategy. The second is to tactically enter into swaps or IRS and convert some of our fixed rate exposure into floaters. Now, for that, we have a view on the shape of the curve, yield curve, which is the underlying bond or the cash curve as it is called. And we also have to have a view on the swap curve. And we have a particular, we keep tracking how the bond swap spread keeps behaving. And based on this spread, we will at various points of time enter into different swaps across the curve. Now, this, tries to capture the shape of the curve, how the shape is changing and how the spreads are moving. So we try to keep our exposure in fixed rate instruments, because not only do they provide us excess liquidity, but once the fixed rate instrument has been converted into a floater by paying on the swap, the underlying duration risk also reduces significantly. So there are two significant advantages that of going about entering into swaps. One, the portfolio is hugely liquid, because even though floating rate instruments are very good instruments to hold, but the liquidity on these instruments is limited. It is not that good in the market. Therefore, if we have a very large exposure in a natural floater, we have to compromise on liquidity. And as you would know, traditionally, HDFC's philosophy always has been to focus on liquidity, pretty strongly. And we feel that keeping a liquid portfolio by investing in fixed rate securities and swapping them into floaters works pretty well. The third aspect is that we would want to have the flexibility to capture the market yields through our reinvestment. So we have a lot of a component of our portfolio. As one can see on this slide, we have almost 1 year, up to 1 year maturity assets are 30% of our portfolio. And as these assets mature over the course of next 1 year, we will be reinvesting these assets at the market yields which would be prevailing at that point of time. So we will capture the movement on interest rates whenever yields rise by, if they rise more in the 1 year segment, or if they rise far more in the 2 year segment. So all that options will be available to us as a large chunk of this 30% of this portfolio keeps maturing going into the next 1 year. All these assets will get reinvested. So not only are they carrying low duration risk because they are under 1 year, but they are also giving us the upside that as these assets mature, we will reinvest them at a higher yield. And the fourth or the most important segment of our strategy is to invest in AA assets, in non-AAA assets, where we can capture the good credit spreads which are there. And this component is adding to the overall portfolio yield. It is almost 12.9 or 13% of the fund. And these AA assets are contributing very well to the overall portfolio yield. So if you look at the portfolio characteristics, I think the portfolio is pretty solid in terms of its credit quality. AAA instruments are almost 57%. GSEC exposure is almost 24-25%. AA, as we just mentioned, is 13%. And even with 6% cash, our portfolio YTM, I think at 470 looks pretty decent. So if one compares this with, other around 1 year duration or 1 year duration category of funds, I think it compares highly favorably. I think low duration, to my mind, is somewhere around 420. We are clearly 50 basis higher. Money market category, what last we saw was around 360, while liquid funds are around 330. So liquid plus or money market 1 year, all these categories are far lower in terms of portfolio yield. Here, we are not only giving today a very good yield, but the upside is that as yields move higher in the next 6-12 months, the fund will benefit from the rising yields, and we will see the portfolio yield also improving. So that is broadly what was there on the portfolio side. I think if you look at the performance of this fund or how the returns are distributed over last 6-month period or 1 year daily rolling returns, it's a very strong number of 5% for 93% of the time, and over 5%, 98% of the time for a 1 year basis. So I think even with a 6-month holding period horizon, a fund offering 5% plus 93% of the time is pretty decent for investors. And I think this can be considered as another category which is very close to a low duration or anything around 1 to 1.25, 1.3 modified duration products. I think this is also stacks up pretty well. So to summarize, in the end, I think we all would agree that yes, the rate cycle in India seems to have bottomed out. I think as RBI gets more and more convinced on the durability and sustainability of recovery, they would start the normalization of liquidity. Then they would start raising the reverse repo rate or reducing the LAF corridor. We expect RBI to move the reverse repo rate first and reduce the corridor from current 65 basis points to back to 25 basis points, which means that the reverse repo rate can go up by 40 basis points. Then I think once the liquidity is removed and the corridor is not narrowed, only thereafter we would expect the repo rate to rise from 4% to 4.25 or 4.5. So that is how we expect the rate cycle to play out. We clearly are aware that this will not happen in a disruptive manner. We don't expect RBI to act, in a knee-jerk reaction. It will be a slow and gradual process. Now, I think floating rate fund that therefore, we are positioned the product, to take advantage of this kind of a movement in the rates going forward over the next 6-12 months. And I think it offers on a risk-adjusted basis, it stacks up really well compared to the other categories in the short duration space. And I think the portfolio yield along, because of the good exposure to non-AAAs at almost 12-13%, is really bumping it up to 470, which is, to our mind, I think is for a product which is close to 1 year modified duration is pretty decent.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.